Today I'm taking a look at First Internet Bancorp, symbol INBK, currently selling at $29.75. This is a rather small bank with a market cap of $189 million. Current PE ratio is 12.97. The number of shares outstanding is 6.48 million. Now let's talk about some of the risks related to First Internet Bancorp as stated in their annual report. Number one, a failure or interruption in communications and information systems could adversely affect the company's revenues and profitability. Number two, the commercial loan portfolio exposes First Internet Bancorp to a higher level of credit risk than residential real estate and consumer loans. Number three, weakness in the economy could materially adversely affect First Internet Bancorp's holding company's business operations. Number four, a decrease in the corporate federal income tax rate may impair First Internet Bancorp's holding company's deferred tax assets. Number five, the market value of some of Internet Bancorp's holding company's investments could decline and adversely affect the company's financial position. Number six, because it is a holding company, because the business is highly dependent on technology, and that technology is subject to rapid change and transformation, therefore the risk of obsolescence. Number seven, First Internet Bancorp's holding company may need additional capital resources in the future, and these capital resources may not be available when needed. Number eight, the competitive nature of the banking and financial services industry could negatively affect First Internet Bancorp's ability to increase its market share and long-term profitability, because larger competitors may be able to price loans and deposits more aggressively. Number nine, the holding company's management team could be adversely affected by the unexpected loss of key officers. Number 10, fluctuations in interest rate could reduce its ability to make these profits. Number 11, an inadequate allowance for loan losses would reduce First Internet Bancorp's earnings and adversely affect its financial condition. Number 12, consumer loans generally have greater risk of loss or default than residential real estate loans. Number 13, portions of the bank's holding company's commercial lending activities are geographically concentrated in central Indiana and its adjacent markets, and changes in local economic conditions may impact their performance. Number 14, because of the company's holding company structure, it depends on capital contributions from the bank to fund its holding company operations. Number 15, lack of seasoning of the holding company's commercial loan portfolios may increase the risk of credit defaults in the future. Number 16, a sustained decline in residential mortgage loan market could reduce loan origination activity or increase delinquencies, defaults, and foreclosures. Number 17, reputational risk and social factors may negatively affect First Internet Bancorp holding company. And number 18, a failure in or a breach of the company's operational or security systems or infrastructure, including the risk of cyber attacks, could disrupt the holding company's business and cause losses. Now let's take a look at its growth and profitability. First, we go down here to its net margins, and the bank has showed fairly decent margins ranging from 20 down to 10, 27. Last three periods are around 21 to 22%. Cash flow, first net income. Net income has been around 6 million, 5 million, 4 million, 9 million, and the last 12 months around 12 million. And the cash at the end of each period, it did peak in 2013, went down slightly in 2014 and 2015, and is coming back up to around 39 million in the last 12 months. Taking a look at its profit margin, it shows a profit margin of 26.8% at the end of December 31st, 2016. Its debt to equity ratio is stated at 1.47. Value Pro's estimate using a 5% growth rate is 29.21. Now, just as a comparison, is if this bank were to grow a percent higher in their model, let's see what we would get. If we put 6 here and recalculate, it would be worth $32.72. On the Guru Focus model, they had also used 5% for the first 10 years, and they get a value of $26.99. However, if you add in the tangible book value and the growth value, then you get a fair value of 51.6. I'll zoom in on that so you can see it a little bit better. So that's what they get if you add in the tangible book value and the growth value, arriving at a fair value of 51.6. Now, if we take the average of 51.6 and the 32.72, we would get an average value of around $42. If we average the two methods, we would get $42 per share.